When it comes to creating financial futures, we embrace many strategies. Real estate is just one of many. And in this Ask webinar, as we're always seeking knowledge, I'm joined today by Christina Wyatt and Darren Mitchell, who are going to talk to us about a thing called infinite banking. Darren, Christina, welcome to Ask.
Happy to be here, Patrick.
Yes, thanks so
Now,
much for having us.
I'm so glad that you're here. You know, when we look at strategies, when we're looking and understanding how do we create a financial future, how do we put a plan in place that we can execute, that's pragmatic, thoughtful, that there's steps to take, you know, that is the key in all of this. So let's start with just an overall, and I don't know which of you is best to take the question, but talk to me about what it is that you do. What is this concept called infinite banking? And what is it? Why do we do it?
Yeah, thank you for the question. So, if we step back just for a minute, we believe at Control and Compound, when we study the wealthy and what they do, if you want to be wealthy, it's pretty simple. Just do what wealthy people do. And what do wealthy people do? Wealthy people do three things extremely well. Number one, they invest in themselves. Join the real estate investing group. Get a coach. Make yourself better. Take a course. Go see Tony Robbins. Whatever's going to make you better, that's the greatest investment you're going to make, followed by starting a business, investing in real estate. So we think that's where you should be investing your money, where for greatest returns. What we do is sort of step one before you get to the investing. Where do you save your money on an ongoing basis, or where do you store the wealth now? So that's the infinite banking concept. And the actual product we use is a high cash value life insurance, which basically means we're driving down the death benefit as small as possible, and we're driving up the cash value as high as we can. And that's going to be guaranteed to go up every year, 150-year track record of paying a dividend. We get a pool of money there, and then we can leverage that for real estate, for business, for opportunities, for emergencies. So that's the product we use, but the concept is infinite banking. The whole idea is tax-free growth forever, uninterrupted by any taxes, fees, volatility, or spending, and then a tax-free retirement down at the end.
Now, is this something that you would do in addition to? So I've had a couple of guests on my podcast in the US side of the equation who have this strategy. I don't know how different it is from the US versus what's going on in Canada. So one of the reasons I was very interested in having you join us is because many people were interested in the concept on my podcast, The Everyday Millionaire, but it was US based. So they were kind of like, I don't know where to go. I don't know what to do. Is there significant differences between US and Canada in this particular strategy?
Yeah, Christina just did a great video on that. So Christina, I'll let you answer that one.
Yeah, for sure. So the infinite banking concept is a strategy, right? So the strategy we can absolutely use in the States and we can use it here in Canada. So the answer is we absolutely can do it here in Canada. Our products are a little bit different. So there is a different product. We use a participating whole life policy here in Canada that's offered. And that's really like when it comes down to the strategy, though, if they were talking about it, just like Darren talked about here, the uninterrupted compounding, the tax-free growth, like we'd almost argue that it works a bit better here in Canada because of the fact that our taxes are higher than our neighbors. We actually save more taxes here in Canada. So the strategy works just the same. We just have to use a slightly different product. That's all.
So can you walk us through, like I'm a 5-year-old, the strategy? Tell me if I'm having a conversation with one of you and I'm saying, okay, what do I need to do? What do I do? Why do I do? Can you just kind of walk me through it all so that it's really simple and I understand it?
Sure. So we'll take let's say someone is saving 20, 30, 40 grand a year, business owner or an individual, doesn't matter. And maybe they're putting it into RSPs, they're putting it into different places. And all we're saying is, let's reallocate some of that money you're putting away. And instead of putting it out of your control, like in a RESP or an RRSP, where that money's basically in prison for the next 20, 30, 40 years, and then they're going to drip it back to you. The bank's in control. You put it in your own banking system, and that's the infinite banking concept. So you say you put that $25,000 a year into cash value. Year one, you're going to have less than 25,000. It's like doing a renovation. You're not going to be better off year one. Long term, you're going to have a lot more money. Long term, that 25 grand a year for 5, 10, 20 years, whatever you put it in, that's going to compound at say 5 or 6%, somewhere in that area, tax free.
Mhm.
Then fast forward a couple years, like I bought a fourplex a number of years ago in Ontario. I needed $80,000 for the down payment. Well, I couldn't go to my RSP because that was in jail. I couldn't go to the kids' RESP. So I went to the insurance company and I said, "Hey, I have this cash value of 100,000 plus. I would like a loan." And the insurance company said, "All right, Darren, we're going to ask you two questions. Do you want a check or do you want a deposit in your bank account?" Right? Because that loan is 100% guaranteed. So when I took that loan in that example of $80,000, that was the down payment. And I went to the bank and I said, "Great, I need a mortgage now for 300 grand." And they said, "Where did you get the down payment?" And I said, "I borrowed against my cash value." So that loan didn't show up on a credit report. It's not considered a loan for borrowing capacity. They gave me the mortgage. The whole time I was taking that $80,000 loan, my full 100,000 or whatever was in there continued to grow at the full amount because you're
Mhm.
not borrowing your own money. You're borrowing money from the insurance company. So your money stays in there. So you really multiply money like a bank. So now my money's in the policy, growing tax free for a tax free retirement. It's providing an increasing death benefit for in case I die now or when I die to keep the properties in the family.
Mhm.
And it's going into real estate. I'm using cash flow and refinance to eventually pay back that loan. And then I rinse and repeat. So we call it and assets. I'm going to have my money in the cash value compounding tax free, and I'm going to do real estate, and I'm going to do business, and I'm going to do Bitcoin or whatever your investment is. So the possibilities, what you can invest in it, is infinite. But the idea of staying on that compound interest curve where most people save, 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 and then they pay cash and go right back to zero and restart the compounding. We all have one lifetime compound interest curve. We want to stay on the compound interest curve for as long as possible.
So just because you talked about a loan from or against your insurance policy, that's, I guess, ultimately the asset or the collateral that they hold that guarantees their side of the loan. Is there a preferred interest rate that you're paying on that loan, or does it vary? How does that part of it work?
Yeah, so there's four different companies we use. Three of them vary and one's fixed, and that's anywhere from 6.5 to 8.5%. A couple of years ago, it was down to 4.45,
Mhm.
but when interest rates spiked. But it's the key of what that loan is. We've got Dan who works for us, one of our wealth coaches. Came from commercial banking, and when he came in, he's like, this loan this is like the holy grail of loans, right? The loan is uncallable. So if the real estate deal goes sideways and you don't want to pay it back in a year like you had planned or whatever it was, you can pay it back when you want, how you want, if you want. The interest, of course, is tax deductible if you use it for investment purposes. But the big thing is unstructured. That paying it back when, how, and if you want, that is huge. Like just
Mhm.
that flexibility for a business owner, because banks are really good to give you money when you don't need it, but when you do need it, and that tends to be when the opportunities are the biggest, is when no one else can access money.
That is really the experience of business savvy is ask the bank for a loan when you don't need it, because generally when you do need it, your financials aren't in good shape. So they don't want to lend you the money. So, trick of the trade, always go to the bank for a loan when you don't need it. That's the best time to get it. Now, going back to that concept, and again, I want to unpack this so that it's as clear as we can make it for everyone. When you go ahead and borrow that money, and let's say you're borrowing it at 8%, the premise of that concept is that you're putting that money to work and getting a greater return on the investment. So traditionally with real estate, you're going to get 14 to 20% without too much effort if you kind of embrace a reasonable strategy. So the spread is between what you're paying on that 8% versus the 14 or 20 or whatever that you might be getting as a return on that particular investment. Am I following that train of thought?
You are. I would just add the difference is now we're having two assets growing, though, because we have the assets in the policy growing tax free,
Good point.
and we have the real estate. We're writing off the interest on the loan. So yes, there is an expense there,
Yeah.
and we have a death benefit. So the death benefit might not be the focus starting out, but I find once you turn 60, all of a sudden that death benefit becomes relevant. And there's all kinds of things we can do in retirement with this concept too. We can get into, but yeah, that's pretty much how it works.
Well, so tell me a little bit about this insurance side of things, because, something you brought up, and being an OG at 66 years old, I know that if I go to increase my life insurance policy, my term policy, or whatever policy I might happen to have, they're going to say, hold on just a minute. You're getting a little old, a little long in the tooth. You're going to have to go for a medical of some sort. And I'm going to have to hit some benchmarks, and that's going to actually tell me what my rate's going to be. So is this a totally different product, different thought processes, or is this still in line with that, what insurance companies traditionally do for those over 60?
Yes and no. The issue, the thing here is we're not buying a lot of death benefit relative to the premiums. So
Right.
the insurance companies are looking at your age 100% and the amount of insurance applied for. So if you apply for $20 million of insurance, you're going through a medical, right?
Yep.
So no questions asked. We can get up to upwards of like $5 million if you're under 50 with a telephone questionnaire.
Yep.
Potentially, if something comes up, well, they might ask for blood. Because we're driving the death benefit down to drive the cash up. Now, if you're 60 plus, yes, they're going to ask you some medical questions, and depending upon the amount, they may want some blood. But under 60, it's Christina, how many cases would we do full medicals versus just questions?
There's not many, but keeping in mind, even though you have to do the medical, if you're in good health, you're still going to get approved, right? You got to do the little bit of work behind it. But what I find, what a lot of people think is when they're, as you age, is that insurance gets more expensive as you get older, right? And that's what they're thinking. The strategy is not going to work. So they're not maybe very healthy, not an issue to get insurance, but it's going to be really expensive if I do it. But as Darren mentioned, we drive down that death benefit. And instead of actually starting with the death benefit, we start with the amount that you want to save each month or each year. So if you want to save $25,000 per year, we're still going to build it for the $25,000. So it's unique in that way that you actually pick your own premium. You pick your deposit, right? So it's a lot different from that side of things. And as long as you're healthy, you can be like, we've gotten people insured like in their 70s, quite like easily. As long as you're healthy, we can do it. And you're the one that's deciding the deposit amount that you want to make. So it's not quite the same as when you would have gotten that insurance policy strictly for the death benefit.
And I'd just add one thing there, Patrick. The other thing, people think insurance is so much more expensive when you get older. And for traditional insurance, like term you mentioned, you're bang on, it is. 60-year-olds, a lot more risk. But if I ran a cash value designed policy on a 30-year-old and a 50-year-old, okay, because we get people at 50 going, oh, maybe I'll put it on my kid. That'll drive down the insurance rates. Well, a 30-year-old and a 50-year-old, their cash value in year 10 would be about exactly the same. So the cash value would be the same. Now, the 30-year-old would have a higher death benefit than the 50-year-old, but really the amount that goes towards the cash would be the same whether you're 30 or whether you're 50. So this isn't treated really like traditional insurance in that respect. It doesn't affect your cash value. It'll just buy you less death benefit for the portion that's going towards the death benefit.
And this is the thing, and this is why I'm unpacking it in this form, because ultimately we don't want to confuse what the actual strategy is. And to your point, this isn't about the death benefit component of it. I mean, that's a factor, but it's not the driving or the kind of primary reason that we're entering into this particular style of insurance / infinite banking. So that's what I'm wanting to make sure that I clear up. So when we come back and apply this strategy, I'm assuming that number one, the earlier you get started on some strategy like this, the better it's going to be over the long term. And then the second question I would have is, when I look at what we have within the RAIN community and those individuals that have been investing for a longer period of time. As a matter of fact, I'm really in a conversation right now with somebody who's 70 years old, has done very well in real estate, but they're looking at it going, okay, how do I take some cash off the table? How do I mitigate some of the tax implications? Is there a tax strategy behind all this? So I know those are two questions and they're kind of unrelated, but that's where we're at.
So let's take that person right there, like someone in their 70s. They did this concept maybe in their 50s, and now they didn't care about the death benefit. Now they're in their 70s. So one scenario could be maybe they're in real estate or the stock market. Both things can be volatile. So when you start taking an income out, volatility when you're young doesn't really affect you too much. But if you've got money in a stock market or real estate portfolio and you're drawing money out each year and you're forced to sell in a low market, like because you want to sleep indoors and eat that year when you're 72. You still want to access money. Where the math just blows up is when you sell at a low. So you retire in 2006, all of a sudden in 2008, you're forced to take money out of your RIF at that 40% down. There's no recovery for that. So one of the strategies from the cash value is to say, okay, when we have a down market, perhaps in real estate or the stock market, instead of selling that stuff low, I'll access loans in my cash value for the next year or two, give my real estate or stock market a chance to come back. Or this death benefit that we didn't really focus on, or sorry, just stick on the cash value. You can also start taking loans now against your cash value in your retirement and never pay them back. Take $100,000 a year loan, you die owing $1.5 million. Well, your death benefit's going to be 4 or 5 million. Who cares? The insurance company takes the $1.5 million that you owe off the death benefit, gives your family a couple million. Or in that real estate investor's case, you don't want to go refinancing all your properties, your personal residence, typically when you're in your 60s and 70s. But if you knew this death benefit you didn't care about that started at $1 million and now is worth 6, 20, 30 years later, my plan is to refinance all my income properties and say, great, I don't mind taking a couple $1 million additional financing as long as they can still be cash flow, spend that money completely tax-free, no risk, and then my death benefit's going to pay off those loans at death. So there's all kinds of strategies, not just while you're saving, but while you're retired, how it can literally double or triple your retirement income and reduce your risk.
Understood. So when you look at the getting started earlier than later, does that in fact make the most sense? And the reason I'm asking this question is right now, of course, the headlines and one of the initiatives that we're involved in is the self-funding house, which is fundamentally, as investors, we know this one really well. You buy a property and you have an ADU, whether that be a suite or a coach home or something. So basically, in the past, it was referred to as a mortgage helper, and some call it house hacking and given affordability, et cetera. When you look at the opportunity that this presents, and how do I, in fact, create call the down payment or the opportunity to invest in real estate. If I start early and start padding this particular system, is that more beneficial? I don't know quite what the question is, but it's part of the overarching strategy.
Yeah, so let's talk about that. So let's say I'm planning on buying a house in 5 years, and I'm younger, starting out. Well, where am I going to save that money? Because I can save it in the stock market, but what if there's a 40% correction the year I'm going to buy? Am I going to sell at a 40% loss? I can put it in a bank account and earn nothing, or I can put it in this vehicle, earn a tax-free rate of return, get on that tax-free compound interest curve, leverage the money in 3 to 5 years or 1 year, whenever you need it, to buy that home. And then I'll have the home, I'll have the ADO, but I'll still have my full cash value compounding for the next 30, 40, 50 years. And it's literally like a snowball, right? We say, picture rolling a snowball for 50 years, how big that snowball would be. Well, that's what uninterrupted compounding is. So the earlier you can get on that compound curve, just the bigger your compound interest snowball is going to be. And we don't think the stock market is the place to save for the short or medium term because of the volatility. We don't think the stock market's great in retirement because of the volatility. We think you'd be better off putting this in something strong and stable. Your risk is going to be your real estate and your business or your other investments. This is going to be the bulletproof portion of your portfolio.
So, Christina, I'll push this question to you because Darren's been talking too much. So we're going to clean that up right now. So that's all good, by the way. I'm just teasing. So, Christina, when you look at some of the opportunities that exist in terms of putting money to work. So, for example, right now, interest rates are the way they are. They're a little bit higher. I can take and keep my money really safe, put it in a GIC, 5%, 4.5%, and lock it down for 3 years, 5 years. Why wouldn't I do that or why would I do this versus that? Any kind of thought process? If I had a lump sum of, let's say, $100,000 or $250,000, it seems to me that this would make sense based on what I understand.
Yeah, absolutely. So that's a great question. And it really comes back to what we've been talking about. So if you just a GIC one is an OR asset. So you either put it in the GIC or you put it in the GIC, right? You don't have the chance to put it anywhere else. With the
Mhm.
policy that we're putting in place, and the GIC is just going to do its thing, right? It does one thing. And as real estate investors know, we want our dollars doing more jobs, right? Not just one job. So GIC does one job, goes up at that 5%, probably taxed, it's barely keeping up with inflation. It's doing one job. If we can take the money and save it inside of our whole life policy, our high cash value life policy instead, we get our dollar doing more jobs for us, right? It's not just sitting there. It's now providing a death benefit for our families. It's now providing those unstructured loans. We have a terminal illness rider that are a terminal illness coverage built in there. We have creditor protection built in there. We have a tax-free wealth transfer to our kids. Like, that's huge. I know we don't talk about the death benefit a lot, but if I could have my family get more than CRA at the end of the day, I'm going to do it, right? And this is going to bypass probate. It's going to go tax-free. It's going to grow tax-free for us just by putting it here. So it's not, you got to get out of the thought process of, do I just do the infinite banking strategy? Do I just do this high cash value life insurance policy? You don't have to make that decision. You just do the high cash value life insurance policy first, and you go do that real estate deal. You have your money working in more than one place at one time, just like the banks do, which is where it kind of where we get that term, right? The banks take your money, they lend it out in 17 different places. Well, we can really do the same thing by adding one more step to your investing. And why not? You could add a step by putting it in that GIC and tying it up. Or you could set yourself up for success with this foundation to your financial plan, provide yourself with all these additional extras. And we didn't even really, Darren touched on the retirement side, but once we hit retirement, like, instead of just using a GIC and then taking and putting it to work into a real estate plan, we hit retirement, we have this nice big high cash value life insurance policy there, and we start taking those tax-free loans. We would have never had that, right? We would have just taken it from the GIC, did the real estate or whatnot. But this way we get both. We get the real estate deals, we get the retirement planning, the uninterrupted compounding. You just have more, right? You have more options.
So back to that retirement part. A good friend of mine, he retired several years ago. He had $1 million net that he had, and he handed it over to his guys and said, okay, I want at least 10% a year. I can live on that. Don't ever touch my $1 million. Like, I have to stay above water on that $1 million. I only ever want that. Now, of course, the best laid plans, and sometimes he does really well. Now, recently he was talking to me and he goes, oh gosh, I'm down to 925,000. I told them I don't want to do that. Now he's going to fire them. So it got really complicated, convoluted. So my question is this: if that same person, if my buddy with his $1 million sat down and looked at infinite banking and said, okay, I want to put this $1 million to work. I'm retired. I want a reoccurring revenue, a monthly income. Does this work for that?
Yeah, we wouldn't take the full million. So we look at it and say, okay, of that $1 million portfolio, maybe he has 20, 30, 40% in some more fixed income type place that's highly taxed. Or as people age, they tend to be more conservative. So as they get there, so we would say, okay, let's take a portion of that million, maybe a few $100,000. We'll put it in this rock solid bulletproof thing. And then when he's down this year and taking that money and the stock market's down, he can say, no, I'll access a loan for my cash value. Market goes back up. I can repay the loan if I want, his choice, or they can just take it off the death benefit when he dies. So it just gives you that extra uncorrelated asset. Typically, everything in the stock market is going to go down at the same time, and real estate is going to go down at the same time. This is guaranteed never to go down. It goes up every single year, guaranteed. So that actually allows you, in your scenario of $1 million, to spend anywhere from 50 to 100% more on your stock market portfolio, because in a bad year, you don't need to access your stock market. You have an uncorrelated access or account that you can access to give your stock market a chance to come back.
This has been fantastic. And I know there's lots of nuances. So as we wind this down, I want you to, give us the last word, maybe each of you. What do we want to make sure that people understand walking away from this? I'm always, having had this conversation 3 or 4 times with different presenters, I'm always asking myself, why isn't this more mainstream? Why isn't it being talked about more, given the practicality of it, the implications, the positive side of things? I don't, it doesn't come even into my purview as much as I thought it would. So that's one side of it. That's why I'm happy to have this conversation and do this particular Ask webinar with you. But what would you want to make sure people understand as we wind this down?
Christina?
Yeah, so I know that you mentioned that why is there not more people doing it? Well, there is billions of dollars that go into these policies every
Sure.
single year. So there are a lot of people that are out there doing it, absolutely. But I think there's just not as many people now. More and more people are talking about it for sure. Like the more
Yeah.
that we've got on social media, those types of things, more people are getting involved. But the bank doesn't sell it, so you don't hear about it. It's not that traditional way that's been kind of drilled into our heads has been passed down from parents and those types of things, right? The other thing is you have to take time to learn it. So for someone that doesn't want to take the time to learn it, you're not going to be able to utilize it. It's just like real estate investing. So I find real estate investors pick up on it very quickly because they're very quick to join RAIN, to get a real estate coach, to learn new things. And if you want to take the time to learn about it, you are going to be able to utilize it, and you're going to be able to make it work really well, just like you've done with your real estate deals, right? So I think a lot of people might not take the time out to take on that extra educational learning about it, which is why you're not hearing about it as much. That would be my take, but we're trying to change that.
Beautiful. And that's why you're on this Ask webinar. And Darren, what would you like to finish with?
Yeah, I just go back to literally the words control and compound, and that's really what we're trying to do. Like for us to, as or let's say a traditional financial advisor, to talk to a successful real estate investor or business owner in their 30s, 40s, and 50s and say, you know what I think you should do? I think you should give up control of your money, put it in a nice balanced mutual fund at the bank, leave it there for the next 30 or 40 years, and then leave it with the bank and let them drip a little each month till you die, and hopefully you have enough money to become successful. If you accept that you're going to make money investing in yourself and business and real estate, then you've got to be in control to take advantage of those opportunities. The and is really the and asset. Everyone goes, or a lot of people go, well, I can get a better return here. Great. We'll do cash value life insurance and that better investment and the real estate, and then the compounding. What people lose on the compounding, people think they know what compound growth is, but there's 4 wealth destroyers that if you don't get a handle on it, these are the 4 things I learned when I studied the wealthy. Wealthy people tackle 4 things: taxes, fees, volatility, and spending. Spending's when you interrupt that compounding and spend your money, like for a down payment. Well, you save 50, 100 grand, now you're back to zero. If you can save that 50, 100 grand, continue to compound it, unaffected by market corrections because it's guaranteed to go up, unaffected by really low fees, unaffected by tax. You play the tax game, especially corporately. If you can do this corporately, it's insane. There's no way you're not going to win long term. And what we like real estate investors is they're okay knowing year 1 and year 2 might not be this real estate deal make me wealthy, but down the road, this is going to be very, very good financially for me. And the infinite banking concept works the same way.
Beautiful. Control and compound. Love it. I will put the links so that people can reach out, connect with you, learn more. This is going to take some conversation with you as the experts to walk people through. I encourage everyone listening to this to step back and see where this might be a strategy that you use in your own wealth building. Christina, Darren, thank you so much for sharing your insights with us. Look forward to talking to you more.
Thanks, Patrick.